Folks, Happy New Year. Welcome to 2025. But now is the time to put the champagne away, clean up the confetti, and grab some coffee because Tom Lee is out with a new urgent message, his latest new forecasts, and his new stock picks. And let me tell you, we are in for a doozy in every sense of the word. Whether you are an investor, trader, stock market conscientious observer, you need to be watching this video in its entirety because this is going to prepare you for not just January, but the entire year. And as always, if you are the one taking the risk, you got to be the one doing the ultimate frisk. Never get frisky without thinking about your risky, and vice versa. And today's video is brought to you by our Santa sale on ZipTrader options. Coupon code Santa will expire in just days, folks. So if you want to get 65% off our one-time fee, make sure to take advantage with that first link down below. So the Tom of the Lead tweets right before New Year's, Happy New Year, FinX. Don't let the flailing final week of 2024 color your perceptions. History shows a weak final week bodes well for January. Technicals, soft. In the near term, many bearish takes equals contrarian bullish. Now we need to look at historical data here. History doesn't have to repeat itself, but it does often rhyme, and January has earned a reputation for being a game changer in the markets, thanks to something called the January effect. Institutional investors and hedge funds typically rebalance their portfolios at the start of the year, reallocating capital into high-growth sectors and undervalued plays. This fresh wave of buying often acts as a tailwind for the broader market, particularly in sectors that lagged the prior year. At the same time, you also have retail traders and investors flush with holiday bonuses or inspired by New Year's resolutions to build wealth. Well, they often flood into markets in January. That's either through financial managers or directly through brokers. This surge in retail participation can create explosive moves, especially in trending sectors like AI, crypto, and EVs. There also tends to be huge momentum from Q4 earnings in January. Here's a fun fact for you. Historically, companies that deliver strong Q4 earnings tend to see their stock prices continue to climb and accelerate in January. That's because bullish sentiment and analyst upgrades fuel further buying, making January a sweet spot for stocks that crushed it in Q4. Historically, the S&P 500 has delivered positive returns in January more often than not. In fact, over the last 50 years, January has seen positive performance roughly 70% of the time. But here's the kicker, folks. You see, the first 5 trading days of the year are often predictive of how the rest of January and sometimes the entire year will perform. This phenomenon is called the first 5 days indicator. If the market starts strong in these first few days, there's a significantly higher probability that the trend will continue through January and beyond. Now, here is where this gets interesting. So Tom Lee comes out and shows data that suggests that when you have a negative last week of the prior year, well, you tend to have a positive first week of the next year. The last 15 times we have the setup that we have right now, well, the first week of the next year was green, and 5 times it was red, and the average return was 1.32%. Now, in the situations where the last week was positive, well, the first week was positive 50-50. So connecting everything together here, look, the first 5 trading days of the year are often predictive of how well January will go, and the historical data suggests that we have the highest chances of those first trading days going very, very green. Now, lastly, you got to keep in mind we have the overall January barometer as well. This is a widely followed market indicator that says as January goes, so goes the year. If the S&P 500 posts a gain in January, there's a strong historical probability that the entire year will finish in the green as well. Since 1950, the January barometer has been accurate roughly 75% of the time. This makes January not just a pivotal month, but potentially the most important month of the year for setting market sentiment. But folks, digging a little bit deeper into this, you have to remember, this isn't just any January. January 2025 is going to be a January like none other. And there's several different reasons for this. I mean, obviously you have the rate cut cycle. You do have cooling inflation overall. You have massive election cycle tailwinds. And it tends to be the case that the third year of a presidential cycle, which ended in 2024 in this case, well, that tends to be the best one for stocks. But that momentum from that year often carries into the early months of the fourth year, especially as markets anticipate policies from the incoming Congress or administration. And Trump in many ways might end up being one of the best presidents for the stock market in history, given that he grades his own performance based on how well the stock market is doing. Now, when you talk about sector-specific trends, we also have a few major trends there. AI being the most notable one. AI stocks saw explosive growth in 2024, and January tends to amplify existing trends from prior years. So stocks like Palantir, Nvidia, and SoundHound could continue their rallies as institutional money chases high-growth themes. When you're talking about crypto, I mean, Bitcoin ended 2024 on a tear. I know it's been a little bit weak the last couple of weeks, but come on. I mean, we've had a massive supercharge in its overall rally this year, and historically, crypto-linked equities like Mara and Riot have outperformed during Bitcoin bull markets. And for small-cap stocks and small-cap ETF like the IWM index, which is Tom Lee's favorite, well, January is often even more lucrative. On average, the Russell 2000 has outperformed the S&P 500 in January by 1.8 percentage points over the last 3 decades. That's a pretty big difference when you're considering you're talking about an overall index, and the S&P 500 itself is very green for January's most of the time. Okay, Charlie, that's great and everything, but why? Why exactly was the market so fussy McGee this December? Why? And specifically at the end, what happened here? Well, we need to talk about advancing issues. What you're looking at here is the percentage of advancing stocks on the New York Stock Exchange during the last 3 trading sessions of the year, going all the way back to 1962. Take a look at that red circle. On December 27th, 2024, only 18% of NYSE stocks moved higher, the lowest percentage in decades for this time period. That's right. That wasn't just bad, this was historically bad. The reason Tom Lee thinks this is bullish, though, is because historically when we see such extreme negativity like this 18%, it can actually set the stage for a massive reversal or rally. Oversold conditions are very nice. When the market gets pessimistic, stocks tend to be oversold too quickly, meaning the selling has gone too far. If you look at the overselling all throughout 2024, well, that is exactly what happened. It oversold, people were emotional, then dips got bought back up very, very quickly. Oversold conditions create opportunities for a snapback rally when buyers finally can step back in. And then again, obviously you have a contrarian opportunity. Tom Lee believes that when everyone else is bearish, even if it's just on a short-term time horizon, well, that's when smart money starts getting super, super greedy. And he believes that if the market was historically negative going into the new year, well, that sets it up for the perfect environment for a January bounce. Now look, you and I have been following Tom Lee for quite a long time, and we know that Tom Lee tends to always be bullish. But he does support his findings with real data. And if you look at the previous market conditions where we had less than 33% of NYSE issues advance, well, 75% of the time, a month later, you were up median 5.2%. If you agree with Lee, well, that means that this 18% figure that we just saw here, it's a signal that something big is brewing for January. Historically, when we see this kind of extreme negativity at the end of the year, the market tends to surprise to the upside in January. Does that mean it's guaranteed? Of course not. This isn't magic, it's probabilities. But what it does mean is that if you're paying attention and you have your game plan ready, there could be some incredible opportunities in the early part of this coming year. Okay, that's all fine and dandy, Charlie, Grandpa Charlie. But Tom Lee predicted a Santa rally was coming, and guess what? We didn't get a Santa rally. Well, we did get a coupon code SANTA for our options membership link down below, which I'd argue is even better. But true, you didn't get a Santa rally. The anticipated rally that Tom Lee had predicted did not materialize as expected, and that's because of several factors that Tom Lee has acknowledged. Number one, a change in Federal Reserve policy, a small shift. They adopted a slightly more restrictive stance, including an indication of fewer rate cuts in the coming years, which likely dampened investor enthusiasm by quite a bit. Could argue that this is a good thing because the rate cutting cycle is going to be longer net. But anywho, number two, there's also economic data. Stronger than expected economic indications and a slower pace of disinflation suggested that the economy might not cool as quickly as anticipated, leading to concerns about sustained inflation and the impact on market performance. And then there's also just a change in market sentiment at the end of the year. Despite positive earnings reports and a dovish Fed, investor sentiment remained cautious all month, and some people took profits off the table after big runs post-election. So, in light of these developments, Tom Lee has acknowledged that his prediction for a Santa Claus rally did not unfold as expected. There was no ho 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 all the way to the bank. Mrs. Claus didn't get her Gucci bag this year. But January is setting up very nicely, and Tom Lee says that he believes that the fundamentals suggest we're going to have not just a hot January, but also a really hot first half of 2025. And that less rate cuts are, again, actually very bullish because it means the cutting cycle is spread over a longer period of time. In his notes, he wrote, quote, "Bottom line, 2024 has shown markets have eluded prolonged periods of weakness. While December has been disappointing, we do not think this is a sudden change of market character. And buying dips has been profitable for all of 2024. The fundamental tailwinds from the Fed and the White House remain intact. Deregulation, dropping cost of capital for businesses, general animal spirits given Republican White House and Senate." So there you have it. There's Tom Lee's latest take. Okay, but what Grandpa Charlie, what Uncle Charlie are Tom Lee's top stocks? Why does he like them? And what are some strategies we could do to play them? Well, number one, MicroStrategy stock, MSTR. So why does Tom like it? Well, MicroStrategy owns the most Bitcoin on its balance sheet of any other stock on Earth. When Bitcoin rises, MSTR acts as a hyper-leveraged proxy for Bitcoin's price, and if Bitcoin doubles, well, MSTR often triples or quadruples in value. I mean, this company literally goes and offers debt at 0% interest rates and uses that debt to go and buy more Bitcoin. It offers shares and uses those shares proceeds and uses the proceeds from those offerings to go and buy more Bitcoin. So this is like the most aggressive way to play Bitcoin if you're buying a stock. Tom Lee is, of course, a big long-term Bitcoin bull with predictions of Bitcoin going up to $250,000 in the next year, and then $500,000 and then $1 million. So it makes sense that he would like MSTR. Now, if you want to play off MSTR, which definitely be cautious with some risk management because this thing goes up and down fast, well, an idea could be MSTR 500 strike calls expiring January 2026. These give you exposure to Bitcoin's potential continued rally while allowing time for institutional adoption to accelerate. Number two, Plus. This is an IT solutions and cloud infrastructure boom play. With businesses racing to adopt cloud computing, cybersecurity, and IT modernization, Plus is perfectly positioned to benefit. Plus has delivered consistent growth in both revenue and earnings, even during tough economic periods. Companies are investing heavily in tech to future-proof their operations, making Plus a strategic partner in IT infrastructure. Now, in terms of a call option idea, take a look at 80 strike calls expiring June 2025. These allow you to target the next couple of quarters where digital transformation spending could drive upside surprises in earnings. Why exactly, Charlito, does this make sense for 2025? Well, cloud adoption isn't slowing down, and Plus stands to gain as businesses continue their digital overhauls. Plus, cybersecurity demand remains high, further fueling growth. And we love growth here at ZipTrader. Okay, number three, Palantir. So why does Tom Lee like this one? Well, it's an AI and big data leader. Palantir is a cornerstone player in AI-powered analytics, providing critical insights for government and enterprise clients. Their contracts with the Department of Defense, the U.S. Army, and allied nations make them a key player in national security. Tom Lee might like them because specific government and private sector contracts awarded in Q4 2024 will likely drive Palantir higher all year long. And Palantir is, of course, aggressively expanding into private industries like healthcare, manufacturing, and financial services. And after years of reinvestment, Palantir is now turning big profits, which could lead to significant institutional buying. In terms of a call option idea, Palantir 80 strike calls expiring January 2026 is an interesting play. I mean, AI growth won't slow in 2025, and I expect Palantir to be a knockout year for, at the very least, the underlying business. But I also believe the stock price. I think this stock is going to go absolutely parabolic all 2025. And AI isn't a trend, it's a revolution. Palantir's leadership in big data makes it an essential player as companies integrate AI into their operations. Number four, PanW. Why Tom Lee likes this one? Well, cybersecurity is absolutely booming as cyber threats grow. PanW's solutions are mission critical for governments and corporations worldwide. PanW's AI-driven cybersecurity tools are leading the next phase of security innovation, making their offerings even more essential. Palo Alto Networks has shown strong earnings growth, high margins, and reoccurring revenue through subscription-based services. Despite its dominance, PanW's valuation leaves room for upside compared to other mega-cap tech stocks. And in terms of a good call option idea there, you got PanW 300 strike calls expiring December 2025. I believe those are an interesting play to look at. They allow you to ride the tailwind of increasing cybersecurity budgets as corporations invest in safeguarding digital assets. Why this makes sense for 2025? Well, every single day now, just yesterday actually, there was a high-profile attack, and quite frankly, when it comes down to AI cybersecurity tools becoming a necessity, well, PanW is primed for growth in that category. Number five, Tesla. So Obviously, Tesla is the gold standard in EVs with global production capabilities unmatched by competitors, but you also have a lot of room to grow in terms of automation, in terms of cyber cabs specifically, in terms of robotics, in terms of a million other things, and energy storage and solar growth is another area, and new factories throughout Southeast Asia and India. Massive untapped markets there in terms of expansion. Tesla 400 strike calls expiring January 2026 gives time to benefit from new factory announcements, vehicle deliveries, and Tesla's growing energy business. Okay, number 6, Meta. So, why does Tom Lee like it? Well, Meta's advancements in AI are improving ad targeting efficiency, driving revenue growth significantly. Meta has emerged leaner and more profitable after aggressive cost-cutting maneuvers in 2023 and 2024. Digital ad spending is rebounding in a massive way, and Meta's platforms are still the go-to choice for advertisers. And as AI continues to transform digital advertising and the metaverse becomes more tangible, Meta has multiple growth levers to pull. And you can already see Mr. Zuckerberg trying to pull some strings with the coming administration. But Meta 400 strike calls expiring January 2026 are an interesting bet on Meta's AI and advertising growth. Anyways, folks, here is the bottom line. January 2025 could be a massive opportunity. The data backs it up. But watch the first 5 trading days. Stay tuned for rate cut announcements and keep your eyes on these Tom Lee picks. And as always, do your own due diligence and have your trading plan ready. And let's all pledge to start this year extra frisky, and always remember to manage our risky. And of course, make sure to take advantage of that coupon code Santa sale that will be expiring in a few short days. Get 65% off our options membership fee, and that is a one-time fee, so make sure to lock in that price now. Anyways, have a good one, folks. We'll see you next time.